Hello everyone and welcome to our webinar for November. I don't know about you, but to me this year is absolutely flying. For those of you who don't know me, my name is Kate Salkeld and I'm an associate with the firm based down in our Sydney office. And joining us today to present the webinar is Adrian Bailey, who is our managing principal, also based down here in Sydney. And I'm sure all of you would have come across Adrian before. In today's webinar, Adrian will be telling us all about family trust elections, as well as interposed entity elections. And he'll be going through the types of situations where it might be desirable or necessary to make those types of elections, how we can make sure we get the elections right, as well as looking at what are some of the potential ramifications that can come about if they're not implemented correctly. So just before I let Adrian dive into that topic, just a little bit of housekeeping in case any of you are new to the platform. So firstly, if you would like to download a copy of the PowerPoint slides, they are available. All you need to do is click on the Files button on the right-hand side of the page, and you'll be able to download a PDF version from there. If you have any questions that come to mind throughout the course of the webinar, feel free to send those through. All you need to do is click on the chat button, again on the right-hand side of the page, and you'll be able to type in your questions there. It is a shorter webinar that we have today, not as much content to get through. So just for today, we'll let Adrian get through all of the material, and then we'll have plenty of time at the end of today's session for any questions you might have. And just another note that this webinar is being recorded and it will be uploaded to both our website and our YouTube channel at a later date. So just to keep that in mind when you are putting forward your questions, but also if you do need to step out at any time, just to let you know that you will be able to watch it at a later date. So not to worry. Okay, so that's all the housekeeping to get through. I will hand over to Adrian to tell us all about family trust elections.
Thanks, Kate, and welcome everybody to the webinar today, as Kate says, on family trust elections. In terms of what we're going to be covering off on, we're going to be running through how family trust elections work, how you can make them, what are the specifications and requirements in order to make a valid one, what needs to be considered when you're making them. Also into interposed entity elections, so that's when we're making an election in relation to another entity within the group apart from what you'd consider to be the primary trust. The imposition of family trust distribution tax, how that works, what the issues with it are, which then moves us into the ATO interest in the area. This is definitely an area where we've seen a lot of ATO audit activity over the past few years, and it's certainly a hot topic and a hot area for them. So one that you need to be across with clients where you either have or are considering making a family trust election. There's a case currently before the federal court involving a family from South Australia, which is listed there. We'll briefly touch on that one. It is at very early stages and is set down for a trial in May next year, but it'll be interesting to keep a watch on that one, and you may have already seen some media coverage in relation to it. I know it's been covered in the Fin Review a couple of times. And we'll finish off with a couple of examples of where we see things go wrong in practice, or have seen them go wrong in practice. Not so much, obviously to show you how easy it is to make a mistake in this area. And because of what we'll go through in terms of how family trust distribution tax is imposed, it can be a very significant mistake to make. So, on that cheery point, jumping into family trust elections, at their heart, they are introduced as an anti-avoidance provision within the legislation to effectively stop or attempt to stop the trading in lost trusts or distributions of dividends through trusts to non-family members. So the main reasons that you would be required or wanting to do one would be if you had a discretionary trust or a non-fixed trust that was in a loss position. You wanted to make sure that those losses were able to be utilised in the future. You may consider a family trust election in that circumstance, or to ensure that franking credits can pass through a trust where it's receiving a franked dividend as income. And that's probably the area where you tend to see it most. Family trust election is made because the trust holds shares in a company which it's receiving large franked dividends on. In order to ensure that those franking credits flow with the franked dividend, a family trust election is required to be made under the franking credit rules. In order to make one, it's a relatively simple process in that you need to make an election in the approved form. You'll find that on the ATO website. They have approved forms there that you need to make the election to. You need to specify an individual whose family group will be the subject of the election. So that's often referred to, and certainly referred to in the legislation, as the test individual. You can make it for any year going back to 2004, 2005. However, at the end of the year that you're making the trust election for, you need to ensure that the trust passes the family control test. And I'll explain how that works at the end of that specified income year. So say, for example, if we're making it for this financial year, we would need to make sure that at the end of the income year, the trust passes the family control test. If we're making it for earlier years, we also need to be comfortable that over that period, the trust will pass the family control test in order to continue to make the family trust election invalid. Make it valid. We don't want it invalid. As I mentioned, can be made for prior years. Just a reminder, though, that only one family trust election can be made for a trust. And these, much the same as in opposed entity elections, I call them generally irrevocable. There are some very specific and discrete ways that they can be varied or revoked in certain circumstances. However, generally speaking, I've never seen those circumstances be relevant in practice. So it's important to remember that point. Once it is made, you can't assume that you'll be able to revoke it. On the contrary, unless you meet those other very specific circumstances, which effectively involve death of the test individual where there's been no distributions, then it's going to be irrevocable. So it's not something you should go into lightly in terms of making family trust elections. You shouldn't be making them carte blanche for every trust that a client has within your group. However, if we want to make sure that we're retaining losses or we're ensuring that franked dividends flow through, then we're kind of going to be a little bit stuck in having to make them. I mentioned the family trust election and the test individual. So once we make our test individual, who we've called the specified individual in this slide, once we nominate them, then the other people that will be part of our family group will be their spouse, parents, grandparents, siblings, and direct lineal descendants. And then also companies, partnerships, and trusts, which either meet the family control test, so they're controlled by the family, or for which an interposed entity election has been made. So we may have the situation, and certainly in one of our examples, we show that situation where a company will pass the family control test. And so with that, it's something that may be able to be utilised in relation to, without making the interposed entity election in relation to that entity. But that's going to comprise our family group. If we make a distribution of income or capital outside of that group, of those people or entities that are within this screen, then we are going to have a family trust distribution tax issue. In terms of the family control test, I mentioned that at the end of the income year, in order to make a family trust selection, we need to make sure our trust meets the family control test. And also, if we're making it for earlier years, the trust must meet it for each of those years from the earlier year until the current year. In order to meet that, the trust must be controlled by a group of the specified individual or members of their family, or a combination of the test individual, their family members, and legal or financial advisors acting in a professional capacity, or the trustees of one or more trusts where the test individual is the test individual for family trust elections made by those trusts. So that would be an example, a situation, for example, in relation to a unit trust. So if our trust meets those requirements and meets the family control test, and most of them will in that circumstance, we will be able to make a family trust election for that trust. Remembering that if we're making one for earlier years, just out of prudence, we should track through those earlier years to make sure that it is still able to be made back to that earlier year. For companies, if we're looking at the family control test for companies, we'll cover off on that now because it becomes relevant as to whether we need to make an interposed entity election. A company needs to be controlled, and I'll come back to what control means, by a group of either the individual, one or more members of their family, so that obviously can include other entities, or a combination of these people. So control is established if that combination or one person have a rights to more than 50% of the voting power or rights to distributions of capital. They must still have the ability to control the application of income or capital, or if they can appoint or remove directors, or if they hold more than a 50% stake. So say, for example, we have our test individual who holds all of the shares in their own right, all of the ordinary shares in their own right in a company. That company will meet the family control test. Where that is important, particularly for companies, obviously, is where we're considering making an interposed entity election. So, as mentioned before, we can bring other trusts or other companies or partnerships into our family group if we make an interposed entity election. The requirements for making one of those is that the entity must pass the family control test. So whether it's a company or trust, or a partnership, it has to pass that family control test. Again, we need to make the election in the approved form. The specified year can be previous years, as long as the family control test is continuously met over that period. And again, except in some very limited circumstances, it's generally irrevocable. So again, if we're considering doing it, and usually we're going to be doing it because we've got a family trust that has a family trust election distributing to these entities, and so that in order to not to invoke family trust distribution tax, we're going to need to make an interposed entity election. We obviously need to make sure that we meet those requirements and recognise that once it's done, we can't revoke that interposed entity election, so it will forevermore be a member of that particular family group for the purposes of family trust distribution tax. On to the nasty part of family trust elections and interposed entity elections. Now, where we have a family trust election in place, where income or capital is distributed to taxpayers outside what are defined as the family group, we have an imposition of family trust distribution tax. Now, with this, that could occur because we're either distributing to people that are outside the family group, so we're distributing to non-family members in the personal sense, or we're distributing to entities to which we can't meet the family control test, or we can't make an interposed entity election, or those entities have made a different family trust election than the one from the trust that we're distributing for. In those sort of scenarios, that's where we're going to trigger family trust distribution tax. So in most family groups, it's generally not speaking going to be an issue to distribute to income or capital outside members of the family group in terms of natural persons. Generally something that's not going to be happening in client groups. However, where we see things get tricked or trapped is where we're distributing to other entities, whether they be trusts or whether they be companies, particularly where you have a large private family group with perhaps a few different generations, or where you have shared ownership of entities between non-family members. You really got to be careful in those situations, as we'll see from our examples. If we trigger family trust distribution tax, that is imposed at the top marginal rate. So currently, including the Medicare levy, that's 47%, and that becomes payable 21 days after the relevant present entitlement or distribution occurs. So if we trigger it, for example, or have triggered it in the 2025 financial year, the year just finished, it would be payable 21 days after we made that present entitlement to that beneficiary who doesn't fit within the definition of a family group. Penalties and interest can be imposed, and generally speaking, GIC is imposed from that day. So it's imposed 21 days after the relevant present entitlement is made, up until when the family trust distribution tax is paid. One of the key parts is that liability falls on the trustees at the time of the distribution. If we have individual trustees, it falls on individuals. If we have a company acting as trustee, it falls on the directors of that company. Now, in respect of company directors, they can get themselves away from that if they can show that they had no reason or no involvement in relation to the distribution, but very limited scope in respect of that. And it's also important to remember that this is joint and several liability. So our trustees are jointly liable. They're severally liable for family trust distribution tax if the tax office decide to pursue them on family trust distribution tax. The real, apart from the fact that you're paying tax at the top marginal rate on this family trust distribution tax, and it's due 21 days after you've made the present entitlement, which obviously, fortunately, can be some time previous. The real issue from a practical sense for family trust distribution tax is that in making those assessments, there is no time limit for making those assessments, or say amendment on the slide, it's really an assessment, which means family trust selections came in the 2004-2005 year. If our clients had made them around about that time, then we could have family trust distribution tax going back until 2004-2005. If we have interest levied from that day, clearly the interest bill is going to be substantial. The other issue from a practical sense in terms of that time limit not being there being no time limit is that what sort of records do you have going back that far? Do you have records going back to 2015? Do you have them going back to 2010? Are they full records or are they partial records? So clearly it can be a mess going back that far. Well, none of us are perfect record keepers, in my experience anyway. And so that's a further practical complication if we're getting ourselves into the world of family trust distribution tax. Sometimes with tax matters and tax audits, sometimes you take the view that because of the period of amendment of 4 years, for example, in normal tax matters, that you'll wait and see what happens because eventually the Commissioner will run out of time to amend your assessment. And that's, of course, a judgment and a discretion call at the time. However, you can't make that call with family trust distribution tax. That time limit never runs out. So if we identify it, then there's a serious issue that somebody else will identify it. And if we don't have a time limit for amendment, then those amendments can be made at any time. Another aspect with it, which is difficult to deal with, there is no discretion given to the Commissioner to either waive or compromise on family trust distribution tax under the legislation. So if it's identified, you can't reach a deed of settlement with them where they'll agree to take a smaller amount because under the legislation they're not allowed to. So it has to be the full amount of family trust distribution tax paid. They're also not able to give private rulings under the legislation on family trust distribution tax. And so if we are, believe it or not, there is a legislative list of things that the Commissioner can give rulings on, and family trust distribution tax is not on them. So if we had a scenario where it was a bit questionable, but we wanted some comfort that we hadn't invoked it, we can't get a ruling on it. Furthermore, the distribution in the hands of the recipient is treated as exempt income. So we have a loss of franking credits. And we'll also potentially, or not potentially, we do then result in really double or somewhat triple taxation. If we've made our distribution to a company, it would have paid tax at the company tax rate. If it's a frank distribution, then it would obviously get that would net itself out, but the franking credits would be sitting in that company. After the provisions of family trust distribution tax are applied, that is now treated as exempt income within the company. You don't get the franking credits applied to it. If you were then to declare a dividend out of it, you would be paying tax from $1. So again, fairly nasty sting in the tail for family trust distribution tax matters. And of course, as mentioned before, the GIC or general interest charge is incurred 21 days after the distribution made. If our distribution is made in 2010, that's identified by the Commissioner, or we come forward about, then we will have GIC incurred 21 days after that, up until the date of payment, if that's in 2025 or 2026. So all of those things make dealing with an identified family trust distribution tax issue very problematic for the client, and really limits your options in terms of what you can or can't do, or also limits advice that you can give to the clients as to ways moving forward. It's really, in essence, putting a gun up against their heads and forcing them to come forward to the Commissioner, because you can never get away from the risk of the time limit for amendment. And then obviously, potentially, this GIC is continuing to be incurred for matters, so you can never get away from that. And on that point, not even going to try to attempt to get into new obligations under the TASA rules in relation to your obligation to whether you have an obligation to report it, or whether if you identify this from another accountant, you have an obligation to notify the TPB. I'm not even going to try to get into that area, but that's also a consideration as to how we should be interacting with the clients. I mentioned at the beginning of the presentation that we have seen a lot of ATO interest in this area. There has been an audit program running over the last few years. As part of that, we've seen a lot of focus on distributions to corporate beneficiaries in terms of where there's a frank distribution made to a corporate beneficiary from a trust. And first off, ensuring or checking that an interposed entity election needs to be made, if it does. But then also going further and checking when did the corporate beneficiary come into existence. It is problematic under the way the franking credit rules work, not so much family trust elections, but under the franking credit rules work, where we have a corporate beneficiary incorporated after the trust receives the franked dividend. So to use an example, it may be the case that we receive our franked dividend on the 15th of June. We incorporate our corporate beneficiary into the trust, I should say. We incorporate our corporate beneficiary on the 20th of June, and we make our trust distribution on the 30th of June. Family trust election issues aside, under the franking credit rules, that distribution wouldn't be able to have the franking credits flow through with it. So because they're focusing on family trust elections and franked dividends, they're also focusing on that area as well. So that's where we're seeing a fair amount of audit activity. For those of us that have clients that are included or will be included in the next 5,000 reviews, considering that there's something like 12,000 or 13,000 taxpayers who fit the threshold for the next 5,000, we have seen it now included as a section on the review checklist. As some of you will know that have been through those reviews with clients, it's a fairly lengthy list of questions that they ask you. But that's definitely now included as a section in that. So if you have a client who is likely to be included in the next 5,000 reviews, then you need to be aware that family trust elections are going to be a question that they ask. Now, there has been a bit of media about this recently, because as what usually happens when the ATO start an audit program or audit a particular area, and, we've seen this with Division 7A, we've seen it with Section 100A, we've seen it with Section 99A and 99B, that there's a bit of pushback from the professions and taxpayers generally, and particularly in this area, when you think about the fairness or unfairness of the legislative regime. And I do recognise that tax law is not meant to be fair generally, but it's particularly punitive in this case, where we don't have an amendment period that expires. We in effect have double taxation if it's triggered. We have interest that can go back some time. There's no discretion for the Commissioner to waive or compromise on it. So it's a really nasty area of the tax law. Recently, the Tax Office put out some guidance to say that until they're offering I wouldn't call it an amnesty, which hence the quotation marks in the slide. But this is a program that they're running until 31 December 2026, so not this December, the following December, that if a taxpayer makes a disclosure in relation to family trust distribution tax that they've identified, there'll be no penalties and GIC will be remitted by 80%. So we'll still end up with a GIC bill, but it'll be 20% of what it would have been otherwise. Now, clearly that can be a fairly large remission or reduction in that GIC if we've got a matter where the distribution was made some time ago. However, it's one of those areas where, as I said, we don't have an amendment period. We know the problem is going to sit there like a ticking time bomb forever as the legislation currently stands. So it may be the situation that we are forced to do this voluntary disclosure. That's done by completing a form. There's an approved form there where you make a disclosure of family trust distribution tax liability, but that's the current program that they're running. Now, in the material that they've put out, because you may have clients where you've identified an issue and you're thinking about making a disclosure, or you haven't identified it, and for example, you get an X5000 review, and those reviews, when you first get them, will say, if you want to make a voluntary disclosure, you can. In respect of family trust distribution tax, you could still make that disclosure. You could still make it. If you're going to make it, you should make it early in that process. And in the material, they say that there's no guarantee that they will remit any interest or remit interest to an 80% in those circumstances. That being said, in practice, I have found where you identify something along those lines and you make that disclosure early in the review process, they tend to stick with the larger remission. So as I said, no guarantee, not set in stone, certainly not something you'd say to clients it's definitely going to happen. But in a practical sense, if that review started, you identified a family trust distribution tax issue when you're reviewing your client documents, if you come forward fairly quickly, my experience is that they will still honour that 80% remission. And that's not advice to do nothing in this circumstance if you have identified it, but just to point out that if it pops up out of the blue, or if we're in the process of making that disclosure and suddenly we get that review letter, there's still a mechanism there for them to still give you the 80% remission. So the current federal court case which deals with family trust selection matters is this one listed here. So John Seymour Property Investments, in its capacity of the John Seymour Property Trust and Commissioner of Taxation. As I understand it, reading through the material that's available so far, it's a large family group, multi-generational, going 3 generations. One of the trusts within the family group made a family trust selection some years ago, specifying what I call granddad as the test individual. Sometime down the track, 2 other trusts within the family group made family trust selections specifying different persons or different family members, the same one, for those trusts, and there's been distributions between the trusts. There has been some attempt made by the taxpayer to vary or revoke that later election without success, and so they objected against that refusal to vary it, and that is now the subject of the federal court proceedings. So there was a directions hearing for this last week, and it's set for a 5-day hearing on the 25th of May 2026. So it'll be an interesting case to watch to see how it turns out. It's not something, and you may have a client say to you, okay, well, you've identified this issue. Should we wait until this case comes out or there's legislative change? Sometimes that's a strategy that you use for tax matters where there's a tax dispute. However, in this situation where we don't have an amendment period and that interest is always ticking, then it's not a strategy that you really want to wait around and hang your hat on, particularly considering that we've only got a hearing set in May. We then have to have a judgment, potentially an appeal to the full federal court, potentially an appeal to the High Court, depending on who wins and loses. So it's going to be some time before this matter is finalised, as we've seen, for example, in the Division 7A world for Bendel. But will be an interesting one to watch to see how it pans out at the end of the day. So to run through some examples to finish off the presentations, and as I said, these are some things that we've seen in the past, unfortunately, and shows it how easy it can be to make a mistake. I think the main problems arise where you have either what you call a larger family group with multiple entities and multiple generations involved, where you've got clients you've inherited from other accountants, where elections may have been made, where you've got clients within the one family who have different accountants and may make different elections because of that. But these are just a couple of examples where there's some issues that have been generated. So our first one, we've got the Camp Family Trust. I might just going to move my camera so you can see that. I'll change the size of my camera so you can see that properly. We've got the Camp Family Trust here with our test individual, Emma Camp. It's distributed to a company called Camp Invest, the shares of which are held by the Camp Number 2 Trust, and also distributed to a company called Camp Shares, the trust of which, the shares of which are held by the Camp Number 3 Trust. Now, because we've got a trust holding these shares, those companies cannot pass the family control test for the purpose of whether they're in the family group to begin with without an interposed entity election. And that's because the trust holding the shares. If we've got individual holding the shares, they potentially could, but in order for them to meet the family control test and fit within the family group and potentially make an interposed entity election, then we need to make a test individual nomination, or a family trust election, I should say, for the Camp Number 2 Trust and the Camp Number 3 Trust. Unfortunately, in this situation, for the Camp Number 2 Trust, the election was made with Emma, the same test individual, as the test individual for this family trust. So that distribution is fine. But the issue arose in this client matter because the test individual specified for the Camp Number 3 Trust was her husband, John. Now that automatically rules out Camp Shares as able to meet the family control test, because John is the test individual, not Emma, and it therefore means you can't make an interposed entity election for Camp Shares. Any distribution from the Camp Trust to Camp Shares would be subject to family trust distribution tax. Now, this kind of reinforces the unfairness here. There's no tax avoidance, there's no tax mischief. We've got Emma here and her husband, John, but because we've made two separate elections in relation to these trusts, then we've got issues with family trust distribution tax. Now, you might think, well, that's pretty silly. Why did they do those different elections? And in this case, it's because these entities were all set up at different times by different advisors. So the Emma Trust and the Camp Invest was effectively the original ones. Later on, Camp Shares was introduced, and at that time, an error was made in that the test individual was made John rather than Emma. So you can't revoke it, can't be fixed, and that will be in that scenario that will be subject to family trust distribution tax. In this example, we've got a business which is operated by three brothers, Max, Brian, and Charles, and they hold 33 1/3% via their family trusts of Tradeco, which operates the business. The business has always been run as a family enterprise. They've always made joint investments. They take money from the business and they invest it somewhere else. And the family has always been of the view that we keep everything equal and we are going to grow our wealth together for the benefit of the broader family. Issue arising here, we've got distributions, we've got dividends being taken out from Tradeco to the respective family trusts, and it's being distributed to a corporate beneficiary, a bucket co, which is then being used as a banker to fund other investments within the family group. The issue that we have here is that we've got three family trusts and we've got separate test individuals nominated for the three family trusts. So in order for our distribution from any of these trusts not to family holdings, not to incur family trust distribution tax, this company needs to meet the family control test. This company was established with the same three trusts, Max Trust, Brian Trust, and Charles Trust, holding the shares within family holdings. So we've got the tech for this one, we'll call that Max's Trust. The test individual is Max, Brian, and Charles. Each hold 33 1/3%. So from the perspective of the family control test, we cannot meet that because no one controls more than 50%. We've got three separate trusts down here with three separate family trust elections holding 1/3 of the ordinary share capital. No one meets that 50% threshold. So all of these distributions here will be subject to family trust distribution tax. Again, you might be thinking, well, that's a bit silly. How could that happen? It could be as simple as these individual trusts being dealt with by separate accountants. Perhaps the family has one key accountant for the business, and then the family members have separate accountants for their own personal affairs, which include these trusts. Or it could just be a mistake, just a plain mistake. A slight variation on that one, where again, we have the same three brothers involved, and they each hold 33 1/3% of the trust. But in this scenario, we've got Max as the test individual of both the Max Trust and the Brian Trust, but still with Charles as the test individual for the Charles Trust. Again, dividends down, distributions to family holdings with Max, Brian, and Charles Trust holding the shares in the same proportions. However, in this scenario, the only the distribution that will attract family trust distribution tax is the distribution from the Charles Trust. So he holds via that trust 33 1/3% of family holdings. So he can't make a family trust election, an interposed entity election in relation to family holdings because he can't meet the family control test. However, a interposed entity election could be made to bring it into the family group of Max, in that if they hold 33 1/3 and 33 1/3, that gets us to 66.67% of ordinary shares. The same test individual is specified here in Max, so that will form part of Max's family group for family trust distribution tax purposes. You meet the family control test, and you could, as best as you can, correct this sum to a certain extent so that these two distributions at the top from Max and Brian's trust are not subject to family trust distribution tax. However, the one from Charles still will be. The other aspect, of course, and that brings into question is when dividends are declared down here at the bottom, we've now got a mixture of what will be treated as exempt income and franked income. But it is a potential way in that scenario of minimising the damage. Damage is still there and it's still been done, but it is a way of minimising that. Last example, we've got two sisters involved in one discretionary trust. You see that on occasion, called the Chicken Trust. And the sisters are Sarah and Sally. With that, Sarah is the test individual for the Chicken Trust. And this is just looking at some of the distributions. There are, in this scenario, it's the same distributions to entities representing Sarah, but part of the proceeds, or part of the income, I should say, are distributed from the Chicken Trust to the York Trust, and some to a company called Egg Shares. Now, with the York Trust, similar to what we've seen in other areas, that's controlled by Sally, and a family trust election has been made specifying Sally as the trust test individual, I should say. So straight away, that leads us to issues with family trust distribution tax. We've distributed outside the family group, going from a family trust with Sarah as the test individual to a family trust with Sally, subject to family trust distribution tax. For Egg Shares, we're actually okay with that distribution in terms of family trust distribution tax. We've got individual ownership here between Sally and Cooper. Cooper being the husband or the brother-in-law of Sarah, and Sally being her sister. Sally is part of Sarah's family group. She holds 50% of the ordinary shares within the company. So that would meet the family control test for companies, and we'd be able to make it, for example, an interposed entity election in relation to that. However, one of the issues moving forward would be Cooper's shares here, and that he's not necessarily part of the family group of Sarah. So again, kind of shows you how things can get messed up a little bit where we have different family groups involved or multiple generations, and often sometimes with the situation with different advisors being involved as well. So to wrap up, as we mentioned, this is an active audit area of the ATO. That no time limit for amendment really removes options for taxpayers. If you find yourself in a situation where you have identified a potential risk, you should consider the current offer provided by the tax office in terms of the remission of that GIC. That will certainly reduce the damage to a large extent, but it reinforces the need for extra caution where we have a large family group with multiple entities or groups with shared ownership within business. I'll hand you back to Kate.
Thanks, Adrian. I hope you're ready for a few questions because we do have quite a few.
Try my best.
First question is from Vivian. I guess more of a practical question in terms of how would the ATO actually know if there has been a distribution made to someone that's outside the family group?
So it would only come up on a review of the client's affairs realistically. They are better at tracking their records of what family trust selections have been made, and they're on the portal these days. But unless, and I don't know this, but unless they're getting more sophisticated in analysing distributions from tax returns, because you have to say who the beneficiaries who've received distributions are, unless they're getting better at analysing that, it's realistically, at the moment, only on a review by the tax office.
Thank you. Next question from Daniel. Daniel said, would it be fair to assume that you would only lodge an interposed entity election for a bucket company if the ownership by the family group is somewhere between 51% and 99%?
Yeah, that's fair to say. Yeah. Or if you might need to do it as well if you've got a trust holding the shares, because you can't meet the family trust family control test there.
Okay, and then there are quite a few questions to do with the unavailability of the franking credits. So I might start with another one from Daniel. He asked, could you please re-explain the timing scenario where you've got a company beneficiary that's established after the trust or after the frank distribution is received? Because it's quite common in practice to form a corporate beneficiary in the last 2 to 3 months of a financial year in preparation for distribution.
Yeah, so this is not specifically within the world of family trust selections and family trust distribution tax. It's more the franking credit rules, and as I said, we've seen it get picked up as part of those queries, and then they move on to that. But if you dig into those rules, it says that the beneficiary must be in existence at the time that the trust receives the franked dividend. So if we have an example where our trust, for whatever reason, receives a franked dividend on the 10th of June, and we only incorporate our company on the 20th of June, the trust can't receive that income related to that franked dividend and retain, the company can't receive the income related to that franked dividend and also have the benefit of the franking credits because it wasn't in existence at the time that the trust received the distribution or received the franked dividend, I should say. And so that's the scenarios that we've seen the tax office pursuing at the moment. As you say, it's quite common to set up your corporate beneficiaries at the end of the year, but if you are distributing income that is a franked dividend that was received before the corporate beneficiary was incorporated by the trust, you're going to have issues with franking credits.
Thank you. Just related to that from Maria. Maria was wondering whether that provision or that rule is related to the 45-day holding rule, or if it is something separate.
It's contained within the 45-day holding rule. So in order to meet the 45-day rule, you have to be in existence at the time of the income. So the company has to be in existence. You can, if you had a different scenario, so for example, you incorporate your company on the 10th of June, you received your franked dividend on the 15th, and then distribute, that's fine. And you can meet the 45-day rule by going past 30 June. But the company has to be there before you receive that income relating to that franked dividend.
Next question is from Rory, which is asking what particular section of the law prevents the franking credits being available in that scenario. I won't put you on the spot for that one. I think it is section 207-145 and -150 of the 1997 Act, and it's to do with the definition of a qualified person.
Yeah, that's right, Kate. It's as you say, it's within how you define a qualified person.
Thank you. Okay. Next
I'm
question.
I'm glad you didn't put me on the spot, because as you know, I
thought that was a bit much to ask. Next question from Kimberly. So to confirm, with the amnesty, as you may or may not call it, can you backdate an interposed entity election still with that in place?
Yeah, and that may be when you work your way through the problem, you may see opportunities to minimise the loss and correct some of the things in terms of by making an interposed entity election. And I guess probably an example of that was in that second example, all the variation I ran through. It may be the case that by making that, and I'll say it's backdated, because we can backdate it in terms of we make it now, but it's for a prior year. You may look to make that for this company so that rather than having all three distributions subject to family trust distribution tax, it's only the one from Charles. So that would be part of the work that you would normally do if you'd identified an issue with a client before you made the disclosure to the tax office.
Next question is from Yvonne. If trust number 1 distributes dividends to loss trust number 2, and both of the trusts have made a family trust election, I assume with the same test individual, does an interposed entity election also need to be made?
Not in that example where the family trust election has been made that has the same test individual.
Thank you. Next one from Chelsea. So for a company to be included in the family group, does a corporate beneficiary need to make an interposed entity election even if the company passes the control test?
Not if it passes the family control test. It's part of the family group, but where you have issues with that is where there's trusts holding shares. But yeah, and you haven't made family trust elections for those trusts, for example, but generally speaking, if it passes the family control test, doesn't need to make that interposed entity election.
Thank you. A couple of questions from Josh in regards to the situation you had on slide 15. So just in regards to this situation, what would happen if Camp 3 Trust had no test individual elected?
So that company wouldn't meet the family control test because it's not controlled by, depending on how Camp 3 Trust is established, it's not controlled by the family group, or very likely not when you dig through it. And so you might be a bit stuck in having to make one. It just depends, and obviously it's a bit brief on detail, but just depends on whether you get across the line in the family control trust with the Camp 3 Trust holding all of the shares in Camp shares. Maybe if Emma is the sole director and sole appointer and sole shareholder of the trustee company. But unfortunately in this situation, in the real life situation where this has been taken from and adapted, we couldn't get across that.
Okay, so just also related to this slide, apart from making an interposed entity election, are there any other strategies that you have seen work around this particular issue?
No.
Okay, next question from Daniel. If the family trust distribution tax is imposed upon the trustee, does the trustee have the legal right of recoverability from the beneficiary that is outside the family group?
Well, that's a good question. I guess they may have the right, but that right's mitigated by the fact that the tax has been imposed by their own actions in making the distribution. So, I think you'd struggle in a practical sense.
Thank you. Another practical question from Jason. If you've got a situation where the original family trust election has been lost, are you able to rely on a stat dec to get around that?
It's not something I've come across. I don't. When you say has it been lost, as I mentioned before, my understanding is that the tax office have been putting who is the test individual on the portal, comes back to evidence at the end of the day, I guess, and whether that would be accepted or not as evidence that it was made and it was made in the correct form. I'm not sure. Sorry, Jason, I can't give you an answer to that one.
I think there's just one more for you, one more question from Daryl in relation to timing. So does an individual need to be a beneficiary of the trust before the dividend is received to be able to receive a franked dividend as a distribution? For example, they get married to a beneficiary during the year.
So they need to be within the eligible class of beneficiaries at the time that the dividend was made. So similar to the corporate beneficiary example, if you got a dividend on the 10th of June and you got married to someone on the 15th and gave it to them and they're only a beneficiary because you got married, then you'd have problems there.
Thanks, Adrian. Glendy, I note your question. I think it's just a bit too specific to put Adrian on the spot, but we will take down your question and come back to you separately. You can see on the screen or on the slide all of Adrian's contact details. So if you do have any further questions that come to mind, or you think you've got a client that might have some issues around this space, feel free to either send Adrian an email or give him a call. There's also Adrian's Calendly link on the screen. So if you access that link, you'll be able to book in either a telephone call, a video meeting, or even an in-person meeting if you would like to discuss something in this space or some other client issue with Adrian. So thank you all for attending today, and thank you for all of your insightful questions. There will be a feedback email that will be circulated later today with just a few short questions. So as always, if you wouldn't mind just taking a couple of minutes to complete that survey, we would be grateful for that. As always, if you have any particular topics that you would like to hear from us on, you're welcome to input that into the feedback email, as we often look to those suggestions when deciding what we will present on next. And I believe this will be our last webinar of the year. So if Adrian or I don't get to speak with you before we close on the 19th of December, we hope everyone has a great Christmas and gets to enjoy some well-deserved time off over the new year. And we look forward to seeing you all in 2026.